search for the next Federal Reserve chair. President Trump is meeting with Janet Yellen later today as he nears a final decision on filling the top spot at the central bank. The two will discuss the possibility of nominating her for a second term, but he may actually decide to move on from Janet Yellen. Let's bring in research and bank analyst at Vertical Group, Dick Bove. Dick, good to see you. Thanks so much for weighing in here.
Thank you, Maria.
What are you looking for from the president on this Fed move?
Well, I'm hoping very much that he does not reappoint Janet Yellen because I see two major problems in the Federal Reserve over the last few years which she failed to correct. The first one is that she did not blend monetary and regulatory policy. Now, what does that mean? It means as the Fed on the monetary side was producing new money, the Fed on the regulatory side was forcing that money out of the private sector and into the Federal Reserve. In other words, over $2.5 trillion was taken out of the banking system and put into the Federal Reserve because of regulations. Now, I went to Washington twice on this issue, and I said to the regulatory guys, don't you realize what you're doing to monetary policy when you do this? And they said, that's not our job to worry about. All we're going to care about is safety and soundness. The second issue, though, is even more important. If you took a look at the Federal Reserve balance sheet 10 years ago, what you would see is that currency, what they print, the money you have in your hands, funds 90% or more of the Fed balance sheet. That's no longer true. Now the Fed balance sheet is being funded by bank deposits. Second, if you looked at the asset side of the Fed balance sheet, you would have seen, 10 years ago that about 90% of the money was used to buy treasuries. That's not true anymore either.
Wow.
And in addition, the duration of the assets on the Fed have got over 56% of the assets are 10 years or longer. So what does this long-winded discussion mean? It means that 10 years ago, you were using long-term money, currency, to fund short-term investments. Today, you're using very short-term money to fund very long-term investments.
I see.
The Fed's balance sheet is an SNL.
So, Dick, it's Kevin Kelly. So that begs the question, if you don't believe in Janet Yellen as the next Fed chairperson, who is the top candidate to take care of the Fed balance sheet as you're talking about? I don't think Kevin Warsh is going to get it because he's too much of a hawk. You have Jerome Powell. They're talking about him because he's more dovish. Who do you think would be the best for this economy in this market?
Well, I mean, unfortunately, the guy I like the best is Quarles, and he's already on the Fed now, and he's going to be the fellow who is going to handle bank supervision, because at least he's going to be looking at the structure of the Fed, and he's going to be, if you will, hopefully alleviating this massive, short-term, long-term situation in terms of their balance sheet. I have no idea whether people like John Taylor, who are wonderful theoreticians, have looked at the Fed balance sheet. I have no idea whether guys like Warsh have looked at, what the regulatory side of the Fed has done to monetary policy. I mean, basically, no one speaks about these issues, but they're important. The Fed balance sheet is a mess. If you were a bank analyst analyzing a bank called the Federal Reserve, you would say this thing is in real trouble.
Speaking of the balance sheet, you're talking about these long-term securities, and you suggest that those are mostly mortgages. You say that if the banks are willing to replace the Fed and the Treasury and mortgage markets, that there will be little to no impact. But you indicated that is unlikely. And my question is really, why should they step into mortgage liquidity? I mean, it seems like a very risky business when you look at the past decade.
No, I'm sorry, you've lost
You're
me.
talking about long-term securities in the Fed balance sheet and unloading.
Right.
One of the things that you had suggested is that if the banks would replace the Fed in Treasury and mortgage markets, then there wouldn't be such an impact. But I guess my question is, would that even be a good decision from the banks?
I didn't make that statement.
Okay.
What I said was that the Fed should not be funding long-term assets with short-term money, and that any entity in the financial industry that does that generally runs into a significant amount of difficulty when interest rates go up, and interest rates are going up.
Dick, there's an op-ed in the Journal today, The Fed Chief America Needs, and it's co-authored by former Treasury Secretary George Shultz. He's suggesting for the president to pick somebody who understands that the economy can grow more than 2% a year. but he's warning that the next Fed chair must not make the mistake of more rapid economic growth for an overheated inflation-prone economy that needs cooling off. He says a Fed that makes such a mistake would only perpetrate the slow growth, low productivity, stagnant wage economy of the past decade. So this op-ed today is basically saying, look, some of these guys don't believe that this economy can grow more than 2%. Do you think it can?
Yeah. Oh, absolutely. I don't think there's any doubt about it whatsoever. I think that if you and I'm going to go back to the Fed for a second, if you take a look at taking $2.5 trillion out of the private sector and putting it into the Fed, you can see that the type of stimulus that we were told we were receiving was not being received. On the other hand, however, this whole argument that is made about secular stagnation in the U.S. economy is, in my view, garbage. I mean, I think that basically, if you get enough buying power in the hands of the American, so to speak, worker, household, et cetera,
right,
you will find that the U.S. economy can grow much more rapidly than 2% a year.
Yeah, Mike Murphy's here. And Mike, remember, in 1984, the GDP was 7.3%. I'm just saying, after the tax package.
And now we're down here and trying to get above 3%. But, Dick, we've liked the banks all year. And now you see they're all sitting right up near recent highs. I'm wondering which banks you think people can look at and buy. And also, part two of that question, do the banks need trading revenue to pick up in order to get another leg higher?
Well, if you're one of the biggest banks in the United States, you definitely, would benefit by seeing trading pick up, but it's not going to because of the change in the structure of the markets. In other words, there's too much money going into passive funds versus actively managed funds, which has a big impact on trading. But I think, in answer to the beginning question, I love Bank of America. I think that, the company is well behind the curve as a result of the huge problems that it's had over the past, we'll say, decade. And I think that Brian Moynihan is doing a phenomenally good job in turning it around. But I think if you take a look at some of the regional banks, companies like PNC Financial has shown, just a staggeringly positive result in the quarter. It outperformed all of the bigger banks, by a mile, so to speak, and it did so by taking business from the bigger banks. So I think that some of the regional banks could be, very, very interesting here. But as I say, two recommendations would clearly be Bank of America and PNC Financial.
All right, and all the banks reported better than expected earnings in the third quarter, despite the weak trading. The asset management business has sort of offset the weakness, I guess, Dick.
Well, again, we could have a long discussion on that one. I think that the asset management business is in a lot of trouble right now.
Why?
Well, I mean, basically, you've got hundreds of billions of dollars moving out of, if you will, actively managed funds, and you've got literally trillions of dollars moving into passively managed funds and into, ETFs. I mean, on another financial network, you have, a very strong spokesperson who got up and said, stop putting your money into actively managed funds. Right. It's costing you too much money. Put them in passive managed, buy individual stocks. And people are doing that, right, and that's having a very bad impact.
Dick, good to see you. Thanks so much. We'll be watching the developments. Dick Bove from Vertical there.